Welcome back to another episode of AM Trading. If you're struggling to understand the concepts of smart money, price action, inducement, and liquidity, don't worry, we've got you covered. In this episode, we'll be focusing on the concept of inducement, discussing what it is and how it works in the world of finance and trading. But that's not all. In part 2 of this series, we'll dive deeper into the topic of liquidity and inducement traps, exploring how to avoid falling prey to the strategies that market makers use to manipulate unsuspecting traders. To make sure you don't miss out on part 2, please consider subscribing to our channel and staying tuned for more valuable insights into the world of finance and trading. We're here to help you succeed, and we look forward to sharing more with you in the future. So where can we find inducements? There are specific points and zones where inducements can be found. These areas include order blocks, support and resistance levels, swing highs and swing lows, as well as trend lines. Starting with order blocks, these are supply and demand zones that are optimized and are very significant for traders as they indicate a potential change in price direction. Order blocks, which are composed of numerous buy and sell orders, are often considered as inducement levels where traders are lured into the market to place their buy or sell orders. However, not all order blocks are deemed valid, and traders should exercise caution when selecting which order block to trade. In the current case, the price has recently broken the structure toward the downside, leading to the formation of a bearish order block. This region is expected to attract traders to initiate sell positions by placing their sell limit orders, as it is a spot that often induces market entry. Nevertheless, it is evident that the price did not follow this bearish order block, resulting in its invalidation and the failure of the SMC traders. Therefore, it can be categorized as an inducement. Traders should be careful when dealing with order blocks, as they can often be deceptive and lead to poor trading decisions. Support and resistance levels are also common areas for inducements, and they are commonly known to be areas where price may face rejection or reversal. These levels represent points on the chart where the price has previously struggled to break through or has been successful in breaking through but has then retraced back to that level. Moreover, traders often refer to these levels as price zones, where they might look to enter the market or take profit on their positions. When the price approaches these levels, traders tend to become more attentive, and the likelihood of price reversal or breakout is relatively high. In the current scenario, the long wick on the chart indicates that the price initially triggered seller stop losses before declining. This move allowed market makers to accumulate sell positions at higher prices while simultaneously taking out the sell-side liquidity from the retail traders. Next, swing highs and swing lows are crucial reference points on a chart, indicating the maximum or minimum values that the price has attained in recent times. These levels are often regarded as significant areas of interest, attracting traders to enter the market. In the 1-hour time frame shown here, we can observe the swing low and swing high. Many retail traders tend to place their buy and sell orders on these levels, assuming that the price will respect them and change direction once it reaches those levels. However, price movements may create fake-outs in these areas, triggering the stop losses of these buyers and sellers. It is important to note that price may not always adhere to these levels, and they may end up acting as inducement levels instead. Up next, trend lines are an essential technical tool utilized to represent support and resistance levels in a graphical manner. These lines are drawn over pivot highs or below pivot lows to indicate the prevailing direction of price. As a result, trend lines also have the ability to act as inducements, tempting traders to enter the market at specific price levels. In the current example, a trend line is visible, and the price touches it several times. Retail traders often place short positions after the price reaches the trend line, assuming that price will respect the line. This scenario occurs frequently, and traders generally place their orders based on their trading plan. It is vital for traders to exercise caution while dealing with trend lines and recognize their inducement potential. It is important to note that not all inducements are valid, and traders must use their discretion to identify which inducements to trade and which ones to ignore. Inducements are sometimes designed by market makers, and traders need to exercise caution when trading these areas. Now we move on to the advantage of inducement. The advantage of inducement is manifold, providing traders with several benefits in the market. Firstly, it helps identify areas of market liquidity where traders are lured to enter or exit the market. Traders can use this information to make informed trading decisions, considering market liquidity as a crucial factor. Secondly, traders can use inducements to flow with market liquidity and realize profits instead of getting trapped in the liquidity manipulations created by major market players. This approach can be highly advantageous, especially for traders who aim to capitalize on short-term price movements. In summary, being aware of inducements can enable traders to make well-informed, strategic, and profitable trading decisions. In our upcoming section on inducement and liquidity traps, understanding liquidity and how to identify it will be essential. We have covered this topic in detail in another video, and we encourage you to review it if you haven't already. We hope you found part 1 of our Why 90% Fail with Smart Money Strategies and How to Succeed series informative. If you enjoyed this video, please give it a thumbs up and consider subscribing to our YouTube channel to receive notifications for the next installment of this series.